Yo, what's good, everybody? Welcome back to another video in the Day Trading Institution. I hope you all have been enjoying the curriculum and the program so far. So I'm going to be going over a lot of different entry techniques. I'm going to be going over scaling into an entry along with scaling out of an entry. I'm going to be going over stop loss and targets, just things of that nature. But what I wanted to cover in today's video, I'm pretty much going to be breaking them down by topics so we could focus on one form of entry on one video and then another form on the other video, so on and so forth. It's a little bit harder to explain what entry we're going to be going in depth into this video, because with this type of trading methodology, with this type of entry, what we're basically doing is we're adding to, I don't want to say adding to a losing trade, but we're scaling into a position practically, right? So first things first, we need to have our risk management down packed before we actually start trading this way. So we all know support and resistance is going to be considered a zone and not a specific level. So what I want to do is pretty much break down to you guys how we can actually scale into an entry. Now let's go over some basic risk management first. Let's say you're taking a challenge account either on FMS or FTMO, doesn't matter, and you have an 100K challenge account. Let's say we're going to be risking around an average of 1% per trade, and risk management is super important when it comes down to this type of entry. Let's say we're going to be risking a maximum of 1% per trade, right? That means per trade, we're going to have a maximum risk of $1,000, right? So now, when it comes down to how many entries we take, we can only have a maximum set number of entries depending on our specific stop loss size, right? So let's say we're waiting for an entry here on gold, and let's just say you want to go short here at $17.95 because this is a level of support and resistance that you've been able to identify on this daily time frame, and you just want to take this short position here on gold. You see prices pulled back and it looks like a pretty good trade, so you decide to take an entry at this point in time. Right now, I'm not going to go over why this specific entry was taken, but let's just say you're going to have around a 50 pip stop loss and you're looking to gain around a 2.5 risk to reward ratio. Let's kind of leave it at there, right? You're looking to target this level of support, right? So how we're going to do this is, instead of just going in, right? Because initially for us to lose $1,000 on this 50 pip stop loss, it's basic math. Let me grab a calculator really quick. Calculator. So for us, we have to understand the basic math behind lot sizes. So we know if we enter a one lot, we're going to be making $10 per pip. And $10 per pip at 50 pips is going to be $500. So if we just multiply that by 2, then we'll be able to see 2 times 50, or my bad, 20 times 50, because we're making $20 per pip on 2 lots. That's going to be $1,000, right? So instead of initially entering a 2 lot right here, what you could do is scale into the position. What you could initially do is, let's say you want to enter one right here right now, and maybe one when price retests resistance, right? So let's just say you're going to enter your first position here for a standard lot size, right? A 1.00, because you see price having the potential to actually pull back and then continue going down, right? So we're pretty much, all we're simply going to do is sit on our hands. So you see how price came up here? This is your second entry level. This is where you would enter yet again, which you would enter another one lot and wait for price to actually retest this area. And once price actually hits this area, you would have another one lot position in at a better entry of about 15 pips. So when this position's in break even, you're actually already in profit $140 because it's a one lot. So now you're in a maximum of 2 lots. You have 2 one lots floating. So if both of your stop losses get hit, you're going to lose a maximum of $1,000, and if your take profit gets hit, you'll make around $2,500 because we're doing a 2.5 risk to reward ratio on this first position. Now notice on the second position, your 2.5 risk to reward ratio turned into a 3.8 risk to reward ratio. So we have a maximum of an $1,000 risk. On this first position, we know we're risking $500 on this first position. On this second position, we're only risking $369. Why is that? Because our stop loss on the first position is 50 pips, which in turn is going to be $500. And our second position is going to be a $369 loss, let's call it. Yeah, $369 loss because we're risking 30 pips on this second position for a total risk of about $869, right? So you're still under that $1,000 maximum risk that you're going to take on this trade, but you entered the same two lots that you would have if you would have just entered two lots here. All you simply did was scale into the position when one of your positions was in drawdown, looking for a better entry, which the better entry would have been right here, resistance. Now, yes, you can add maybe another 0.30. It really depends on the size of the stop loss to get to that 1,000. But now let's look at our initial take profit. Let's do a comparison, right? So if we would have just entered a direct two lot here on this first position, which was making us 2.7. So all we simply have to do is look at the math. So if we would have done a two lot, we would have been risking $1,000. We would have been risking $1,000 to make a potential $2,500 in total. Now, if we were to look at this position here, right, we have a $500 risk on our first position. So this is example one. Example one is going to be the example where we only entered one position, right? Example two is going to be the scaling in strategy that you can use. It's an entry methodology, right? So example two, right? I'm going to put here position one, right? So we know our position, our first position, we had a total, let me grab the calculator again, of a $500 risk, because again, a one lot at a 50 pip stop loss is going to be $500. So what we're going to do is multiply our initial risk, which is $500, by our potential, notice how I said potential reward, right? So we're going to multiply this by 2.5, not 0.5. So let me undo that. 500 times 2.5. So immediately we're going to have a risk of about, or a potential reward. So we're risking here $500 to make a potential 1240. I believe it was 1250. Now, on our second position, notice how our stop loss is significantly less. Again, if we're making $10 per pip and or losing $10 per pip, a 36 pip stop loss, meaning that this is where we're going to close at a loss, is going to be $369. So now what we're going to do is simply multiply $369. We're going to multiply this by 3.82, which is our risk to reward ratio. But you have to keep in mind, right, our stop loss is our lot size is exactly the same. So our lot size is going to make us here around an extra $1,400. And that's because the lot size is the same. We're still making $1,000, right? We're still making $10 per pip. So all you simply have to do is multiply this 10 by your potential reward in pips, which is 141 pips. And that's going to give us a $1,400 gain. Let me pull up, not the notes. So that's going to give us a $1,400 gain. So what we're going to do now, so we have, again, we have a smaller risk here of $369 for a potential reward of 1410. So now what we're going to do is multiply both of our potential rewards, giving us a 1410 plus 1250, which is $2,660. $2,660. And that's not even us risking a total of $1,000. That's us risking $869 or 0.2%, almost 1/4% that we're saving on risk here. So we made an extra $160 just by simply looking to scale in on this position here. So I'm going to recap what we kind of just went over. So what I did here is break down you taking one position at an $1,000 loss, potential loss here, because that is 1% of our account, versus you actually scaling in on the position, meaning that you're going to put one position, your very first entry is going to be a 50% gain, and your very second entry is going to be my apologies, not gain. Your first position is going to be a 50% risk of what you would have initially entered, meaning you're going to cut the lot size in half. And then your second entry, which should be a better entry, is also going to be a 50% risk as well, for a total of 100% risk on that 1%. So what I mean by that is you're going to risk $500 or 0.5% on your first entry, and you're going to risk another 0.5% on your second entry, giving you a total of a 1% risk. But in this situation, since our first entry was higher than our second entry, there is a smaller risk. Notice how on our first position, we're risking a flat $1,000 versus on our second entry, we're risking about $869. Now, as you can see, that is a pro where we made a little bit more money by risking a little bit less, which is a big pro, definitely, especially once you start trading in the tens of thousands of dollar range, then you'll definitely see a big difference. This is a methodology that I use when I actually do swing trade. Now let's kind of cover the pros and cons of this. So obviously one of the pros is that you can have multiple different entries. The key component is if you're gonna risk 1%, or it doesn't matter, let's just say you're gonna risk 2%, right? You have to figure out how many entries you're gonna take one. Are you gonna do a maximum of, I don't know, 4 entries, where you're pretty much gonna split the 1% into quarters? So you're gonna enter a 0.25% risk on your first position, a 0.25% risk on your second, a 0.25% risk on your third, and a 0.25% risk on your fourth entry, giving you a total of a 1% risk. Because you have to remember, you can enter 4 different entries at 4 different price ranges within this entire area here, but your stop loss is going to be at the same level, along with how much you lose. It is never going to surpass what you initially expect to lose. So if you're expecting to say, okay, on this specific trade, I'm okay with losing $1,000, which is 1% risk on my account. Okay, then you have to figure out and you have to do the math on how many lots you actually have to enter and how many positions you plan on entering. And you also have to keep in mind, sometimes you won't be able to enter a second, third, fourth position because maybe on your first entry you were already right, and making a second entry wouldn't, or entering a second position wouldn't make too much sense if price is already in your favor and you're almost at a 1-to-1 risk to reward ratio. So you do have to keep that in mind. This is also a way for you to be able to scale in on positions slowly as well, take a little bit less risk in terms of that, because again, like I said previously, when you enter 2 positions, you're only entering, let's just say you're going to do 2 positions, right? Some people can do 3 positions, some people can do 4 positions. Ultimately, at the end of the day, it's really up to the trader and, you know, how they see things working out best for them, right? For me personally, I think entering 2 positions just makes things a lot simpler because you just cut the positions in half. You have 2 areas where you look to actually take an entry from. So as you guys saw here, I took an entry based off a confirmation candle, which is, again, it's just a random example. That wasn't a real entry that I would have personally taken. And then my second entry, I wanted to enter another retest of resistance because let's just say my first entry was very, very aggressive, right? So you could do that. Let's go over one more example. Let's see where we could find an example here. Okay, see a perfect example right here. Right, so I'm actually going to end the replay, restart it. So let's just say you're waiting for price to come back up, retest resistance, and you're looking to actually go short into this range here, right? So you're going to take an aggressive entry after the first rejection of resistance, which you're going to wait for, which, as you can see right here, would be your first entry. So now let's give you guys another example with a little bit more math behind it. So again, let's just say we want to use a 50 pip stop loss. And again, let's use the example that we're trading on an 100K account. Now, granted, I know not everyone's trading with $100,000, but a funded account is definitely something that's more accessible nowadays. So you have an 100K account balance, and let's just say you want to risk 2% on this specific trade, right? Now, let's say your target is all the way down here for an 175 pip gain, right? So you're risking 50 pips to gain 175 pips, and you're looking at a 3.5 risk reward ratio, right? Now, granted, this position is a very aggressive position because you entered off of the first rejection of resistance. So let's give you guys the two examples there. So if you guys go back into the entries video, right, one thing that you could do is tie multiple time frames together. So what I would do is tie the hour and the 30-minute time frame together. So if I go on the 30-minute time frame and I see that this is an actual medium probability engulfing candlestick, then in this situation, what I would do is I would split my position in half. But I want to give you guys both examples. Keep in mind, we have resistance, right? Price came all the way back up to resistance. We have this engulfing candlestick pattern here, followed up by a loss of momentum. We already starting to see the probabilities play out in our favor. Notice how buyers tried to break above resistance here, but buyers couldn't hold previous resistance as support. So this is a very strong level of resistance. Now that sellers or buyers have brought price all the way back up to resistance, what's the probability of sellers holding this level of resistance again? And that's going to be, and the answer is very simple. It's going to be very high. Sellers are most likely going to continue to hold this level, right? So let's take one position here. Again, I'm going to do both examples of how you could benefit off of this. Let's just say you're going to have one position right now and one position as an aggressive and as a position that's a little bit more conservative. So what I'm going to give you guys is on example one, you simply took one position after a confirmation. Example two will be our scaled in methodology on personally. That's just how I like to do things, right? So on example one, we're risking 2% on an 100K account. And if you do the math, $100,000 times 0.02 is going to give us a $2,000 risk. So all that simply means is if price hits our stop loss, we're going to lose $2,000, which we've identified our stop loss is safe up here at a 50 pip loss. And here's our entry. So essentially what we're doing is we're risking 50 pips to make 175 pips. And if you want to know what your potential reward is, right, all you're simply going to do is enter the math. So you're going to multiply 2,000 by 3.53 times 3.53 equals $7,060. So if you were to take this trade, you have a guaranteed loss of $2,000 because again, once price hits your stop loss, we're out of the trade, and you have a potential risk of $7,000. Now I'm saying potential because you never want to say it's a guaranteed win. There's no guarantees in trading. The one guarantee that there is in trading is how much we know we're going to lose on that trade. And if you're a trader who's emotionally disciplined enough to actually close your position at your stop loss, then it's, you know, that's a guaranteed loss. Something that's predetermined in trading is how much we're risking, but something that's unpredictable is how much we make. Because price could blow through this level of support and we can continue to hold the position. Instead of making 7,000, we make 12,000, right? So anyways, so example one, we have a $2,000 risk for a let's just leave it at $7,000 reward, which is still pretty great, right? But now let's take a look at a different example here, right? So I'm going to erase this, right? Now, let's do some math. Let's say that we want to actually use the same stop loss area, right, after the first rejection, because essentially what I like to do and how I like to scale in on the positions is I'll enter my first position very, very aggressively, right? So our stop loss is going to be in this area right here. Now remember, I'm going to enter two positions, right? So my first position is going to be right now after this rejection of resistance, which this is a confirmed rejection of resistance because one, look at the loss of momentum and look how weak this candlestick is. Notice how buyers tried pushing price above resistance, but sellers pushed price all the way down and we ended up closing back under resistance. Granted, this is a high risk trade because I'm trading it very aggressively, but we have a big loss of momentum candlestick here. So I'm going to take my first entry at a 50% risk. This type of methodology is very similar to using a limit order, except the only difference in this situation here is that we're waiting for one rejection candlestick, this is a rejection candlestick, right? So this is where I'm taking my first position. On my first position, I have a 32 pip stop loss. So let's try and calculate how we could do the math there. So we know that a one lot is going to be $10 per pip, and if we multiply that by 32 pips, that's only going to be a $320 loss. Now remember, we're risking 2% of 100K, which is going to be $2,000. So we're trying to risk $1,000 on this first position, right? So if we enter a 5 lot, which is a 50 pip gain per pip, or $50 gain per pip, and we multiply that by 32, that's going to give us something a little bit over. That's going to give us a $1,600 loss, which we know is too big. So let's scale it down a little bit. What if we entered a 3 lot, which is going to be $30 per pip, and we multiply that by 32? That's going to give us around a $960 loss there. So we could probably do, let's say, a 3.3 lot, which is going to be $33 per pip. Multiply that by 32. That's going to give us something that's a little bit over. So let's do a 3.2 lot, which is 32 times 32. And it's going to give us pretty much 1024, which it's fine. It's practically the same thing. You're losing an extra $24. It's not big of a deal. It's not that big of a deal. So what I'm going to do is I'm going to sell my first position for a 3.20 lot, which this is going to be, remember, from this point here to this point, I'm going to lose a maximum of 1024. Now on our first position, all we simply have to do, again, if we're risking $1,000, right, all we have to do is multiply $1,000 by our risk reward ratio, which is 6.2, right? So notice how just in our first position alone, right, we're still risking $1,000. We're risking less, actually. Remember, our first position, we were risking $2,000 to make $7,000. In this situation here, we have a 6.2 risk-reward ratio, meaning we're risking 1024 times 6.2, which is going to give us $6,348. By risking literally 50%, we're almost making exactly what we would by taking less risk. Now, let's actually enter this. So, example number 2, position 1, we're risking minus 1024 to potentially gain $6,348. So again, notice how just by kind of splitting your positions in half, you could potentially minimize your risk and increase your reward, because you knew already that this is a trade setup you wanted to take. You wanted to sell at this resistance. So what I like to do is I like to enter an aggressive position right here. And what I'm doing is I'm literally minimizing my risk, also maximizing my reward. So I'm going to enter this risk or this position here. So I'm already in a short for 3.20 lots. And what I'm going to do is I'm going to wait for a confirmation candle where I'm going to enter another position, which here's our confirmation candle right here, that big engulfing. Now I know it's a medium probability candlestick, but now let's do the math here. So here in this situation, we have a 50 pip stop loss and we have a potential 170 pip gain, should be the same pip gain, but our risk to reward is a 3.5. So notice what we did by cutting our or entering our positions and scaling in on our positions, right? We're minimizing our risk since we're taking a very aggressive entry on the first position, but at the same time, we're maximizing our reward. So all we did, and I'm trying to repeat this multiple times for you guys so you guys can actually get this instilled in your head and not confused, right? So again, all we did was minimize our risk, maximize our reward by taking an aggressive position because we already knew that's a trade we wanted to take, and we cut our first position in half and look to enter a second position after a more conservative entry, which we're still risking the same $2,000. It's just the strategy of entry is very different. Now, some people could argue, well, what if you just entered a $2,000 risk here? Keep in mind, entering here is a lot more riskier than your conservative entry way down here. So yes, you could do that if you have a higher risk tolerance, but just know you're going to lose a lot more trades that way. Why is that? Because we're taking more aggressive positions, right? This is why we want to take a more conservative approach on the risk on the aggressive positions, and you could take a more aggressive position on a conservative entry approach, right? So now we have a 50 pip stop loss here. We can enter one lot, or no, actually we can enter two lots because two lots at a, well, two lots is $20 per pip. At a 50 pip stop loss is going to be $1,000. So now we're going to enter another position for two lots, 2.00 at in minus $1,000 risk, because again, we're only trying to lose a maximum of 2% if our stop loss gets hit. So now we have two entries. We have a 3.20 lot and a 2 lot, giving us a total of about 5.20 lots. Now all we're simply going to do is look at our potential reward, which if we take a calculator, we multiply 1,000 by 3.59. That's going to give us $3,590. So position 2, we have a total of an $1,000 risk and a potential gain of 3,559, I believe it was, for a total potential gain of about 6,348 plus 3,559, $9,907. Right, and obviously, I mean, we already saw what happened with this specific trade, but notice how it went down and pretty much came all the way down to the target. Try to give it a little bit of time, and there you go. As you can see, it hit all the way down to the target and went even below that, so you could have potentially made more, right? But notice by scaling in on our entries, right, what we initially did was turn a $7,000 potential reward with a $2,000 risk into a $2,000 risk with a $9,000 reward, right? So I'm going to do the example right here, regular entry, and then scaled in. I can't believe I typed scaled in wrong. And there you go. And that's pretty much the power of actually scaling into a position, or scaling into an entry, which is, it's something that's definitely very powerful, but it's gonna take a lot of getting used to And I've had really big days using this methodology. I've had 70K days, I've had 50K days, literally doing the same exact thing. Why this entry methodology is so powerful is because we're decreasing our risk and maximizing our reward. But anyways, hopefully you guys did enjoy this video. If you really did like this video, drop a comment under the video. And if you ever have any feedback on any of my videos, let me know. For those of you who've made it this far in the course and you really enjoyed the video, give me your feedback on this video. I would really like to know so I can continue to make videos just like this, going over entries and exits and stuff. With that being said, in the next video, I'm going to go over a more of an aggressive, not an aggressive, but now that I've gone over the more of a scaled in approach to an entry, in the next video, we're going to literally talk about when you should enter the market and where you should exit the market. And we're pretty much just going to be going over different setups.